Hello traders, thanks for joining us today on this Convergent Trading study hall. This month we're going to talk about zero DTE options with gexbot, with Jasper from gexbot. Very interesting topic. I know there have been several requests on this. I want to remind you that derivatives trading is not suitable for all investors. Past performance is not necessarily indicative of future results. The information contained here is for education and informational purposes only. Make sure you do your due diligence before you trade it. I hope you're all well and are excited to move forward. Here's what we're covering today. We're going to introduce Jasper to you. We're going to talk about what zero DTE is, what impact it has on, we'll ask Jasper what he thinks the impact is on futures trading. He's going to cover that in his discussion. How Jasper's using gexbot, how are the levels being used? He's going to share some details with us, setups, things like that. And how does he recommend traders would start to use zero DTE in Gex? I want to throw this out there, and we'll throw the link into the chat as well as on our into the chat as well as on our page with regards to an offer by gexbot by Jasper here. If you want to try this out once we're done, you can take advantage of having 75% off for the first month. To do this, point your browser to go to ct.pro/gexbot. Use promo code Convergent75. You have 2 weeks to take advantage of that promo code. Again, 75% of gexbot by using Convergent75. This must be used by midnight on February 13th. So, Jasper, can you hear me?
Yes, I can hear you. Thank you, Rod, for having me on.
Yes, absolutely. So let's start with you. Just, like a 1 to 2 minute reel about what brought you to trading. How did you get to the point where you've built gexbot and so on? How did you get into the world of trading, Jasper?
Oh, I mean, the very start was really COVID, actually. That March 2020 volatility. That's when, Wall Street Bets was going off, and I got first drawn into options. For a very long time, I was really just a swing trader, or really just buying the index. And then it wasn't until COVID hit, everyone was at home, and then I found out about options trading. But it was later on that I started reading about squeeze metrics, also spot gamma, right? They were talking about gamma as a way of measuring the options markets. And then from there, I started looking into it myself. I wanted to make my own personal tool, and then that's sort of how gexbot came about.
Sorry, did you have a software development background? Is that how you were able to kind of take on such a big project?
I was doing my master's in computer science. Originally, I was studying AI or machine learning, but then I kind of sucked into the markets, and then it's been a kind of a wild ride. But that's sort of my background in terms of coding. Yeah.
A lot has happened for gexbot. I remember meeting you here in Chicago. That was fun. So, Jasper, do you trade this when you do you day trade this when you're using it? I know you can't. You said you were swing trading. Are you currently day trading, or how does this? What's your time frame?
Yeah, I was getting into ES, so like very short time frame scalping, probably around like 2022. And then currently I'm primarily trading NQ because ES I found is a little too thick in terms of the scalping that I like to do. And I pretty much exclusively use gexbot. I have my ladder open, And these are like the levels that I look at. That along with
Got it.
volume profile, but almost entirely just gamma now. Yeah.
Okay. Can you explain to us what 0DTE is? Just kind of a layman view of what is it that we're talking about when we're saying 0DTE? Or do you want to get into this on your presentation?
Yeah, I'd rather dive right into it if possible.
Okay, very
I'll go in
cool. Let me
first
hand you
here.
the screen here.
Awesome. All
There
right,
you go.
is
You
it
should have
playing?
it.
Perfect. Okay,
There we go. All right,
so,
have at it.
all right, why do we even want to look at the options market if we're trading futures, right? You know, typically people are looking at volume profile, order flow. What's sort of I want to go over the core reason for looking at the options markets. And then I'm going to talk about some case studies, and then we can do Q&A after that.
Sure.
So I know you guys have heard a lot about the statistics of zero-day options, about dealer hedging mechanics, gamma squeezes, you know, your nth Twitter thread about some second order Greek. But for the sake of this talk, I kind of want you guys to forget about all of that. I want to start from first principles, and it's for two reasons. First, I want you guys to get a sense of the core motivation behind building this tool so that you can also do it yourself. There are free APIs that you can use to get a rough measure of this kind of data, and it doesn't require too much options knowledge, just a little bit of coding knowledge. Secondly, I think starting from first principles makes it easier to go from thinking or data analysis to actual trade execution, especially because the options market, it's very complex. There's a lot of data in there, and it's very easy to get bogged down in analysis paralysis. So we're just here to look at the options market for what we care about, which is just intraday futures trading and nothing else.
Okay.
Okay. So why look at the options market? I think of it as a marriage of two concepts, that being volume profile and order flow. So volume profile, I'm sure you guys are very familiar with already. But the core driver behind using volume profile is to plan out your trades, right? You have an idea of the structure such that if you're in a trade, it's much easier to manage it when you're expecting some sort of price action like a local reversion. It's easier to hold your trade through stuff if you have a plan, right? The issue with volume profile is that it is all historical. It's all backwards looking, right? So we're looking at where liquidity used to be, where there was lower liquidity, and then we're sort of, assuming that this will carry forward into the present. But that may not be the case, right? And so typically that's where order flow comes in, right? So order flow, what you're just trying to do is you're measuring whether there are more buyers or sellers, right? The issue is that you can only measure locally, right? So you can only measure where spot price currently is. Secondly, there's no proper or sound way of measuring fair value, right? So we have concepts like VPOC, so we have an idea of what used to be fair value, or like high volume edges, like the edges of value, but that's not current necessarily, right?
Mm-hmm.
Additionally, with order flow, if you're looking at absorption on the offer, you can kind of think of that as either aggressive buyers being absorbed by a large passive seller, or some version vice versa, right? So every buy is always met with a sell definitionally, and they have opposing incentives, right? One is expressing a thesis on spot price going up, and the other one's expressing a thesis on spot price going down, and they meet in the middle, right? So that's where options profile comes in. So we get the benefits of looking or having a bird's eye view of structure, right? When we're looking at the chain. But these are live positions that are transacted, right? So you can look ahead of developing structure without spot price having to be at that level to inspect it, right? It's similar to looking at the limit order book, where, you know, oftentimes if you're looking at LOB, you're looking at where limit orders are being posted to get an idea of where liquidity might be. But the issue with the LOB is that those are limit orders, right? They can be canceled. They're not actually, there's no risk being put down. And then crucially with options, because they have an expiration and they have, meaning a time limit, and they have moneyness, which is the difference between a contract strike and spot price, we can actually theoretically derive a fair value for the contract, meaning that we do have a sound basis for saying, okay, the customer bought the contract or the customer sold the contract. And then additionally, you know, for the majority of these options or a great deal of these options, it's customers transacting with a dealer, right? So a customer is expressing a view on directionality, volatility, but the dealer does not have an opposing viewpoint, right? He's just there to provide liquidity. Their incentives are orthogonal, such that if we do classify customer as a buyer, it's just a buyer, right? There's not like a seller who's opposing him on the other side. And so we get the marriage of, you know, volume profile and order flow while shoring up the cons of each. Does that make sense? Are there any questions?
So far, so good. So let me check the questions here. Unrelated, does gexbot work with stocks? This person's thinking about Apple, using it for Apple. Do you guys connect that way?
So theoretically, yes. It's just that, so most of our research is done with index options. It really just varies in a very specific way where we look at index options as hedging instruments, whereas for equities, you know, it's far more common that it's speculative and it's not a hedging instrument. But it's a lot fuzzier there, I will say that.
And yeah, because it's not as broad, right? And then the other question we have here is, do you trade options as well as futures while you're using this option information?
I stick to just futures. I think options execution is very difficult. Futures, so, you know, the benefit of options is we can do all this math, we can measure all of this, but we don't have to do this on a live basis, right? All of this is automated. Therefore, when we're focusing on futures, I can just focus on execution, which is just setting my stops and my take profits. I don't have to worry about all the non-linearities in options execution. So I just stick to futures. Although John, my partner, our head of research, he does exclusively trade options using gexbot, and he does not like trading futures. But I think that's a personality.
Yeah, it's not for everyone for sure. Okay, very cool. Okay, let's keep moving forward.
Sweet. Okay, so gamma, the most contentious term on Twitter. Gamma is just a multiplier. Okay, there's nothing special about gamma. The reason we use gamma is to filter options data down to just what we care about. Okay, you know, there are other Greeks, but they're all exposures to second order curves that you can't trade, or we can't trade with futures directly, right? And so there's two aspects of gamma for why we care about that. One is that it's highest for near-term expiries, meaning for zero-day options, kind of by definition, they have the highest gamma. That's the only, there's nothing specifically particular about zero-day options that, it's just that they're, you know, by definition about to expire the soonest, right? And more specifically, because gamma is highest for nearest expiries, it means that these are positions that are being affected by today's price action the most, and not some unknown time frame in the future, right? So if you're scalping intraday, you don't care if someone's putting positions on for next week, next month, next quarter. You care about what's happening today. And so gamma just lets us look at only those positions. And then secondly,
sorry, Jasper, just because most everyone here is a futures trader, I'm just gonna quickly go over not all the Greeks, but the ones that are relevant here. So we have a price of the premium on an option. You know, think of it as like your car insurance. There's you know, $500,000 of coverage, and the premium for that coverage every 6 months is $2,000, let's say. Options are the same. It gives you the right to that coverage to up to $500,000 in coverage from the insurance. If something happens, if nothing happens in that 6-month period or when the insurance policy expires, then it's worthless. You don't get any money back, right? So options on futures or stocks are the same, but with stocks, with options, you have even more math to deal with, which we never look at when we look at car insurance, and that is what is the rate of change of that premium for every dollar that the option moves, or for every incremental move of the option. For example, an option that's out the money, which means that it is away from being valued at the strike price or the price that you bought the call or put at. As prices below that, the change in the premium isn't as fast as an option that is at the money, where for every dollar that the underlying moves, the option value, because it's in the money, it moves at that price. So think of delta as the rate of change of premium related to the rate of change of the underlying. For example, Apple's at $100. I have an option that has a $100 strike, meaning it starts to become valuable above a call option, which gives me the right to own Apple's stock if it expires or gets exercised above $100. As long as it stays below $100, you know, the change in Apple's price doesn't impact the value of my option that much. But as soon as the price of Apple goes above $100, for every dollar at 101, my option gains $1 in premium, and it goes in lockstep. Now, what is gamma? Gamma is the rate of change of delta. So it's like, that's why Jasper is referring to a second derivative. So you have the stock, Apple, then you have the option based on Apple's stock, and it comes at a premium. Think of that like your car insurance. It's just an agreement that is set to a certain expiration date and a strike price. Delta measures how the price of that premium changes. So if we were dynamically pricing, as an analogy, the value of insurance premiums during the California fire that just happened, this massive tragedy, you would imagine that if the insurance can reprice your coverage as the fire is approaching your house, that insurance is going to get dramatically more expensive, right? In fact, they'll start to charge you dollar for dollar what they're going to pay you in coverage. They'll start charging you that in your insurance plan. But as long as the fire is going the other way, and your insurance coverage on your home is expiring at the end of the month, as the fire kind of moves in the other direction, the premium, if you can get some money back, would get cheaper and cheaper. A very crude and terrible analogy, but I just want to kind of give you a real life example. So again, you have the value of your home. There's a premium to buy insurance on your home. That's the value of the option. The change of that premium is the delta, and the change of that delta is gamma. I hope that makes sense. We're trying to squeeze 16 books of options trading into like a 10-minute discussion. I didn't want to take this over. You're going into some things that futures traders don't usually deal with, and I wanted to make sure that's covered. Anyway, go
No,
ahead. Sorry about that.
totally. I think a really, really maybe reductive explanation is like the contract value is sort of the distance you're going to travel with a car. The delta is the speed at which a car is going. And then gamma is just how hard you're pressing that pedal, right? How hard you're accelerating. That's really what kind of like in my head I think about gamma. So these
Very cool.
contracts, if they have very high gamma, the value, the rate of change in their value is very high. That's what leads to, I'm sure you've seen those EOD, these penny options that turn into like $10 in the change of like an instant, like a few seconds or something, or a few minutes really.
Yeah, that's what that
That's
whole
the high gamma.
AMC and GameStop game was
Yeah,
all about.
the meme stock craze, yeah, the gamma squeeze.
Okay,
Um,
go on,
but
Jasper.
But yeah, so those contracts with high gamma, they behave, or their exposure means that those positions behave closest to futures, right? Because with futures, we can only trade changes in spot price. We can't trade any of the wiggly stuff that options are usually used for. So gamma is just a way to also further narrow down the options market to just positions that are closely related to the stuff that we're directly trading. And that's the motivator behind using gamma. Okay.
Okay.
Now next tidbits, and then I'll go into the examples. These are, there's quite a bit of an involved process that leads to these statements. Not this one, not this first one, but the point of getting here is so that we can get to a compressed rule set. But the discussion of how we get to this kind of logic is I think beyond the scope of this talk. But really just a couple of statements. One is that options are primarily, and this is for index options, they're primarily for hedging. They're not, or they're very rarely used speculatively. There are, of course, the obvious exceptions like EOD, right? So that if it's like the last 30, last 20, last 10 minutes, then how we view the latter is a little bit different. But typically we think of them as hedging instruments. Now, when someone's buying an option, they are removing liquidity at a level, right? So if you think about, you guys can see this ladder, right? You can see, you can think of
Yes, we do.
someone buying an option as removing liquidity at that strike. And if they're selling an option, they're providing liquidity in those areas. You can think of it as if you could place an LVN away from spot, but on a live basis. So, right, when we're looking at the LVNs or low volume nodes on volume profile, it's all historical. But imagine you could make a thesis where you're saying, okay, this area, 200 points above us, it's going to be an LVN. And that position is being put down to express that thesis. And then on the other side of that, if you're selling options, you're providing liquidity. It's as if you're marking HVNs or high volume nodes or expected high volume nodes in some area.
Okay.
Now, so after that, when we think of a bought contract, so we're saying the customer went long that contract, then we just multiply it by gamma. So it means long gamma just means the removal of liquidity at that strike. And then if something is classified as sold, it's a short, and we multiply it by gamma. So it's short gamma at some strike. And I think of long gamma as LVNs, short gamma as HVN. So the rule set is very simple. Long gamma, we look for reversions, just as you would look for reversions at LVNs. And then generally for short gamma, with futures, you typically don't want to participate in the auction when we're within value, right? Because it's hard to, you can't set risk that way. So generally we're looking to traverse short gamma to whatever the next long gamma node is. And that's it. That is, all of this comes down to this rule set. And the rule set is very, very simple. It took a couple steps to get there, but each step I think, or we think, is pretty logical. with as few assumptions as possible.
So,
yeah, are there any questions?
so can you, I guess maybe in the next step is to show an example of how you are using a long gamma node as a target or pivot. And so are there examples of what a reversion looks like and things like that?
Yes.
Great.
Okay. So we had established, this was last week, this was on the 24th. We established 093 as the week high, new all-time high, actually. We had failed down the next day. Then overnight, we're ranging. Then spot price opens right here. And then it's at this timestamp where we see 081 pop up as long gamma. And that aligns with the prior high at 093. So there's two things going on here. One is spot price is here, and there's interest here 052 and 081. So one trade is, okay, I know that there's interest here. Generally, I treat long gamma as targets. So you can look for a long to get there. And then secondly, we treat this as an LVN. It's aided by the context of being placed just about the prior week high at 093, just under. So you can look for the fade. So you look for a short here, and you can set the stop at the prior week high, which is 093. But generally with these long gamma levels, risk can be set very tight. This is somewhat dependent on volatility. So if volatility is very high, these levels tend to be very crisp. So you can get, even on NQ, you can get as close as like a 10, 15 point stop. The hard part is getting filled at those levels. That's the difficulty, because even if you set a limit there, it's very difficult to get filled.
Okay, so Jasper, just to be clear here, we're looking at the NQ, and yes, you're relating the 081 to 22,081 level to the prior week's high at 93. The way you're relating those is because that's the difference between the spot index versus the future, right? It's the delta between those, or the price difference between those is the premium. Is that what you're referring to?
Yeah, so these are, oh yeah, I should probably clarify that. This ladder is looking at NDX options transactions. And then in the pre-market, we're getting the premium addition to translate these levels into NQ levels. So even though these are technically NDX options, I'm reading this as NQ levels. And there are, due to like number of reasons, there's variance in that premium, so they're not going to be exactly aligned, and this is kind of dependent on like carry costs and stuff like that. But generally, it's within a 10 to 15 point variance within like the actual Q level.
Okay, so as I come in and look at gexbot here, how, and then we have a chart on the left there that shows, the high is 093. How am I relating those? Just want to be clear about this point. How am I relating the 081 on gexbot to the last week high at 093?
So, a standard play, I think, is, okay, we've established an impulse high, and so maybe we'll look to fade it, or maybe we'll look for breakouts over that level. But here in this case, when we open, the fact that this node was placed, and remember, so we're always thinking about options as a hedging instrument, not as speculative. So the idea is, a very common example is if you're long a call and then you're short futures. So in this case, you could be, okay, well, I long the NDX call at this level, and then I punch short futures, right? So there's another point here that I think helps provide context with thinking about long gamma as being hedges or reversion areas. So with futures, we can only trade spot price if it goes up or down, right? But spot price can go up quickly in a volatile manner, or it can go up in a grinding, slow price action manner, right? And then same for if it sells, if it goes down. But in futures, even if you're setting stops, you're still always exposed to two of those scenarios, right? So that there's 4 in total. So if you're going long, you're exposed to both of the short side scenarios, whether it drops fast or drops slow. But if you were to combine a long call gamma hedge with a short, you're actually only exposed to one scenario, which is if spot price comes up to that prior week high at 080s, 090s, and then breaks out slowly. If it breaks out quickly, you have this long call that gives you that exposure to range expansion. And so you're not really losing on your delta 1 short. And then of course, if it fails, presumably you've aligned the proportion of your deltas of that contract with however many contracts that you're short NQ. And so yes, your hedge will die, your call hedge will die as we sell off, but you'll be still positive on that P&L off your D1 short.
Mm-hmm.
Right? So I'm always thinking about that marriage of positions, so to speak, in terms of looking for reversions. Yeah. Okay. And then another one, it's somewhat simple. It's the other perspective. Same day, we had sold off to 980 overnight low. We had bounced off it. There was some short continuation trade that was possible at this long gamma node, right? Maybe here, but that would have failed. But we retraced into overnight low. The bids get weaker, right? Our retraces are lower and lower. Then finally at 12:30 Eastern, we see 9.0 up pop up on the ladder. And that in combination with weakening bids, we're on this compressed level of 980 overnight low. 901 is also the H high volume edge of a lower volume distribution. So we read that as a target, it's interest, right? So now we're looking at the tape, we're looking for the breakdown to reach that target. And then it's pretty quick. It's only like a few minutes to look for that join of the breakdown.
Okay. So you'd have to front run that somewhere to get fills. Like you said, it's the tough part's getting filled on these,
Yes.
right? Okay.
Yes.
Cool.
Yeah. And then one last example, but this is literally from yesterday. This was off FOMC. I wasn't sure about putting this example because it's a little bit different, but I'll quickly run through it. So it's 2:18. It's 10 minutes before JPOW starts talking. We had established a prior low at 387. And then all of these are puts. These are all people who, so I should clarify, for event volatility, that's when index options are much more commonly used for speculation as opposed to hedging. So we can think of these as people who are long puts looking for a sell-off. Now the thing is, if they stay out of the money, we have one constant in this case, and that's vol crush, meaning as vol crushes, whichever side has more long gamma, the value of those contracts will collapse. And you can think of it as squeezing toothpaste out of a tube. So if these contracts stay out of the money, meaning we stay above this belly of gamma, then as vol crush occurs, all of these puts, their value collapses and we get shoved upwards off of that. And so the point here is that we don't know if spot price will go up or down, but we do have that limit, that border of, okay, where are the bulk of the contracts flipping from in the money or out of the money? And so you can set risk very tight. So if you want to look for the long, it favors the long because there are more puts that are vulnerable to vol crush. And then your stop can be the prior low, which was like 377-ish, but it can be very, very tight. And then that's it.
Very
And then
cool.
here
So,
we see the ramping.
okay, I thought you were done. Yeah, go ahead.
Oh no, and that's it. We see the ramp up to 560, I believe.
So I want to ask you, not to put you on the spot or anything, but I
Mm,
want to ask you, Jasper. Well, you're looking at the NQ. Is that now your primary piece? I remember, a couple of years ago it was all ES,
yes.
not much NQ, and then you switched to NQ, I guess. Are you mainly focused on NQ?
Yeah, so what I found, I mean, and this is really emergent from building this ladder, to be honest, because NDX options are very inefficient, the positions that people put on there are much more clear. People who are trading SPX, there's way more different reasons, right? So there are people who are selling puts on SPX, they're selling iron condors, they're like doing a bunch of stuff that mucks up what we're looking at, or makes it much harder to kind of pinpoint these sorts of levels. Whereas NDX, there are way more efficient ways to express trade theses than NDX, like QQQ is an example. So when people are putting on positions on NDX, there's sort of we put a little bit more weight to that because you're not going to transact in them unless you have a real reason to.
Mm.
And that's why the levels are much more crisp than like ES, SPX.
So can I ask you this? Can you show us your GexBot on the one that members would
Yeah,
subscribe to?
yes.
Show us what that looks like. And just if you can just we know we need to get into questions here, but if you can take us through a walk of
Right here.
what today it said to you and what sorts of plays you would have had on today's book.
Yeah. I remember when these puts came in. These are long puts at 512. They actually came in off the open. I won't be able to replay that because it'll take a minute to load history.
Yeah.
But this is a very, very common example where we just, we're selling off or coming down into this long gamma node, and then we just step off it, and then we just get that reversion. And there's also even this fade here where we had this cap at 620, 623 that capped spot price, and then we fell down. And then presumably right now I think we're heading towards, well, 586 is short gamma, so there's probably some muck here. So like if you were taking this long off 512, you probably peel at short gamma at 586, and then preferably look for a runner to 623, back to not day high, but is that IBL, IBH? Oh, noon high.
Let's see.
Yeah, so there's not really any, that's it. There's not really much more to it. Of
Okay.
course, there's other stuff like looking at skew, but I think that's a little, you know,
Do
too silly.
you does this give you, as the market opens on this chart at 9:30,
Mhm.
do you get any perspective from the market positioning as to whether today will be um, a day where
What
you
kind of
might sit on
bias,
your
right?
hands? Yeah, or a bias
Oh,
like, hey, I'm going
yes.
to sit on my hands today because there's just nonsense all over the options market, or hey, this has a strong buying skew or something like that. Can you pick up like clues early on based on how people are positioned as the market
I
opens?
I literally just don't trade unless long gamma pops up. That is actually it. Part of that is because, if people are lifting options, there's an expectation of volatility. So, and those are the days, I mean, yesterday was crazy. I mean, that ladder was like very, very, this is very uncommon, this amount of long gamma. typically you'll get like 1 or 2 nodes. Some days you'll get none. And those days that you get none, it's just, you just sit on your hands because they're not expecting a lot of realized volatility, meaning they're not expecting much range. So there's just nothing worth participating in. But when those do pop up, I mean, they're just, you know, part of this color maybe, but like they're very, very clear in terms of where we're looking to go, where I might look for reversions. I think 900 has popped up, although that seems a little, that's a little far. I don't know about that. That's like the upper volume distribution here.
How does that line move up? The one that went to 900 there, 904.
Yeah, this is just, it's literally just a peak finder. So we're just looking for, there's a little bit of interpolation that's going on of this. You can kind of imagine a curve along the tips of these bars. And so this is just marking the absolute peak of long gamma, max long gamma. And then same with short gamma. So 64 is like the quote unquote muckiest part. And you can see it aligns in this case with the, this is like the value area high, but is on this profile distribution here.
Okay.
604.
Can you show me your settings on this 1 second?
Yeah. The only thing, so I'm not on my typical setup. I'm on a VirtualBox because you guys don't like Linux or Linux apparently. But I usually just do this. I just hide the 5 and 30-minute priors. But that's it though.
Okay.
I
Very
have the
cool. Okay.
benefit of like when we add features, I do it by my taste, so I don't have to change settings because it starts off as mine.
Well, it just makes it easy as you're explaining. It makes it easy to see what you're doing, and then of course everybody that might get on GexBot will want to replicate what you're doing. You know, so that's why I ask.
That's a very good point. So this view, this latter view, I should have said that, is this node. It's gamma. This is what when I talk about long short gamma, this is that viewpoint. I know the original viewpoint was this one. There's a bit of distinction between what we're doing here and the long short gamma, namely that this is call and put gamma and not long or short gamma. But for futures trading, I just stick to this view. No other view matters.
Okay. So we're in the questions portion here before we head out. Let me just find those. Does the 75% promo code apply to any of the GexBot subscriptions, classic versus state versus order flow? The one you're on is state, right?
Yeah, so the coupon applies to any and all of them. I would not recommend starting with order flow. If you're new to this, I would just start with state or even classic. But order flow, there's a lot of information, and we're still working on our education. So I don't want you guys to get overwhelmed if you're going to try that. This ladder on state I think it's pretty intuitive with a little bit of observation. But yes, the coupons apply to all packages.
Okay. The next question I have is, there was a point earlier where you said, you know, there's a buyer for that option, and Steve is saying, but there's also a seller for that option, isn't there?
Mm-hmm.
So how is
Yes.
it's almost seemed like it's one-sided in terms of how you were speaking about it.
So it depends on how the customer is being filled. So yes, there are transactions where it's a customer with one perspective on, let's just say, directionality, and then there's an opposing customer, or there's a customer with an opposing viewpoint on directionality. And those transactions, I want to say it's the way that we're measuring is that we're ignoring those ones. We're just looking at ones where it's a customer being filled by a market maker. Thus, we know that the incentives are different. And so we can just stick to classifying the customer, and we know that the dealer is not expressing an opposing view. We're also looking at how dealers are filling people to tell us things about the customer, but that's trade secret stuff.
Okay. Do you look at 0 DTE to remove theta from the futures equation?
Yes, exactly. It's a great question. That's why we look at gamma, is so that we don't care about, because when there's a lot of theta, right, then the value of the contract is not as directly affected by changes in spot price, right? There's like other stuff that with futures you can't really trade theta, right?
Right. It seems like the options act as a sort of contrarian indicator. Is that true?
Mm-hmm. Yes, that's how I view it. I think it's a little bit different because I know that there's a common adage about like gamma squeezes and dealer hedging momentum, but it's our view that that literature is a little outdated, or at least that yes, there are dealer hedging mechanics, but we care about the customer because the customer is the one who's moving stuff around. Dealer is just trying not to get run over, right? He's just trying to like fill people's orders and not get in the way.
Right. They're the ones that just hold the book and keep it flowing. Is this only available for NinjaTrader?
We have a Sierra integration as well. And I'm working on a Motive Wave 1 for myself finally. But yes, it's NinjaTrader and Sierra and the website.
You're hopefully you'll let Ian know when the Motive Wave 1 is up and running. Would you, I think you already answered this. Can you ask Jasper if he would recommend the order flow version? I noticed some in the Discord was having some success with it. I think you already answered that though.
Yeah, I use order flow because there's some very particular, it lends itself to like very hyper local scalping, but I really don't recommend it because it's a lot to digest, right? I just start with state, get a feel for that. Hopefully we'll have more resources to explain order flow, but yeah.
Okay. Tom's asking, I just want to confirm that we're looking at filled contracts on the graphic.
Yes, they are all actual transactions. There are no limits. We're not looking at like, we're not displaying quotes. We're using quotes, but we're not.
Okay.
Yeah.
You have one vote for Motive Wave in here. Does the subscription provide include access to an API?
Yes. So the API comes with the subscription. The integrations, from NinjaTrader or Sierra, they all come with the subscription. That all comes with it. Yes.
Okay, cool. I'm gonna grab the screen here as we conclude. I don't have any other questions.
We do have one question. It was kind of already answered, but I think this is more directed towards either him or his clients. This was in the Discord chat. I would be interested in hearing about whether or not they use any 0 DTE hedging strategies on their intraday futures trades and what that looks like. So it sounded like you did say that like you would hedge with the options for your position, like you mentioned going long on call options when you're short underlying. Is that accurate? Or
that's an example of like how one might pair that trade. I personally just, I find like execution is hard enough. So maybe it means that I have to sit more trades out because I'm not adding options to the trade and just sticking to futures. But that's just my preference. But there's like a very theoretically optimal way. I mean, there's a very crazy way to trade this ladder too, which involves like buying and selling straddles all across the chain, literally just at every strike. That's like an extreme example. But no, personally, I don't, you know, I like to
Thank
keep
you.
my trading rule set simple.
Hmm. Okay,
That's it.
cool. JC, we don't have anything else, right?
That's correct.
Awesome. So just want to remind you, if you want to enhance your view on what's going on that's impacting the futures by using Gex and 0DTE options, you have a month you have 2 weeks to sign up for a month at 75% by going to this link. Go to ct.pro/gexbot using the promo code Convergent75. Remember, you got to use this before the 2 weeks are up if you're interested. I know Jasper's got a whole lot in terms of education. Like there's just a lot in there. It's really interesting. I think even though maybe you think, well, you know, I'm just going to trade outright futures using what I have. What this is, in my opinion, and when I got into this a few years ago, when I got introduced to Jasper, it just kind of opened my eyes to something else. And what we don't want to do as traders is to just become really set in our ways, become myopic, and not consider, hey, there may be something else out there. I want to also supplement this by saying that you know, through the partnership that EdgeClear has with CME, we get a lot of information relating to options and options activity. And I'm going to tell you that the volume on options has absolutely exploded over the last few years. I mean, the impact of 0DTE is likely to be a lot more than we're able to see as traders just looking at the ES, NQ, RTY, YM, and so on. So it's worthwhile, I think, just from a well-rounded trader perspective, to have a look at this. Like I said, you'll have a month at a deep discount. Check that out, get educated, see if it's something that you can use. I know they have a Discord, and so on to supplement that education. And of course, you know, we know these guys, and they are very, very focused on performance and the details of what's happening within that space. Jasper, thank you so much for taking the time out of your day to come on here and educate us about what's going on the 0DT and the Gex side. And thank you all for attending. Of course, the recording will be available this evening. If you want to watch it again, or if there are details that you want to replay, you'll have that. Thanks so much for being with us, Jasper, and we'll catch you soon.
Thank you, Murad. Thank you guys for having me. Have a good one.
Thank you,
Take
Jasper.
care, everyone. We'll see you in the chat room. Take care. Bye.